another episode of Capital Markets Quickie. I'm your host, Endred Sella, the investment fella. So I was listening to a podcast on Bloomberg. Yes, even podcasters listen to other podcasts. And, well, they delved into the world of recessions. But not just the generic term we've all heard 1,000 times. They actually dug a little bit deeper into two specific types, namely inflationary recessions and credit crunch recessions. So let's break it down in our everyday lingo. Picture this, you're on a diet, I'm on a diet, and you're trying to shed those few extra pounds. An inflationary recession is like when you have to slow down on the sweets to eventually hit your weight goal. The economy, just like your body, sometimes runs a little too hot. And the Fed, the central bank, steps in, just like a dietitian, raising interest rates. And what is the result? Well, obviously the economy cools off to help bring down rising prices, much like cutting out those tempting desserts. But this diet means we might have a few tough months ahead, especially due to those cravings we all get late at night when we skip the ice cream or whatever we like to eat. Now, that's your recession. So let's move on to the other kind of recession, the credit crunch recession. Now imagine you're planning a big trip with your buddies and suddenly your credit card gets declined. And this has been known to happen, but now you're panicking, and of course, that happens in the economy as well. That happens when there's a glitch or a block in lending money, and businesses can't invest, and folks, just like you and me, might struggle to buy homes or cars or plan vacations, and so on and so forth. Now, this sudden standstill in financial flow, that's your credit crunch, and when this happens on the large scale, we land in a recession. Like when your entire weekend goes down the toilet because of that one credit card hiccup. So why does everyone seem so nervous when strong job numbers come out? Well, because the Federal Reserve has this tough job of ensuring the economy doesn't run too well. I know that sounds confusing, but think of it as a car engine. If it runs too hot for too long, it could damage the engine. So therefore, the Fed steps in, slows things down, and thus avoiding long-term harm. And on the other hand, people also get nervous when interest rates remain too high for too long, because that makes spending and investing and booking those vacations much more difficult. Now, the Fed is faced with difficult decisions of trying to slow the economy down, but at the same time not raising interest rates to the point where it causes a credit crunch. And that's why the Jackson Hole meeting, which we talked about just a few days ago, is so important and will keep you up to date. So remember, everyone, even though the word recession is just thrown around like a football, they are all not the same, and understanding the difference will help you make smarter financial decisions. All right, guys, that's it for today, and make sure to rate my podcast and subscribe, and remember, sharing is caring. Cheerio.